from that perspective, it is beneficial to have a job and to have self-employment simultaneously. Very good point.
That means two of them together paying 9.9%.
So,
Yeah.
but once you reach your 9.9%, it doesn't become 13.5.
Yeah.
No, it's just
So when do you pay the CPP? After you claim all your taxes and
good
then
question.
say,
No, simultaneously.
oh, okay.
So when you calculate someone's taxes,
Mhm.
that's when you start looking into the income, the expenses,
Yeah.
and John, that actually brings up a very interesting point. I was going to talk about it in a little bit later, but the amount of CPP that you pay, the amount of tax that you pay, ultimately depends on your net income. Everyone understands net income?
Yeah.
So when you have your business income, you have your business expenses. The difference between the two, that's your net income. The more you can reduce your net income, less tax you will pay and less CPP you will pay. CPP, I mentioned CPP and EI, they both have a ceiling. So there's a certain threshold. Once you pay that amount, you won't need to pay anymore. Not EI, but CPP also has a minimum. So the minimum is $3,500. So if your income, for the sake of argument, is $3,499, you don't need to pay any CPP. But the minute you are more than $3,500, then you start paying CPP. More questions? Very good.
Sorry. So you said the moment you make, well, when you're making less than $35,000 a year, then you don't need to pay CPP? You
Correct.
just said.
So CPP only kicks in after you've earned, after your net income is more than $3,500.
But I thought you said, like if you make $11,000 a year, you still.
It's a good point. So technically speaking, on 11,000, yes, you will be paying CPP, but actually it won't be $1,000. It will be about $700 because on the first 3,500 you don't pay CPP. Okay, so let me take that example. No, you're right. You're right. And actually, CPP only kicks in after 3,500. So in a situation when your business income is $11,000, you don't need to pay any taxes, but you do need to pay CPP. I mentioned that CPP is about 10%. So on $11,000, it would be $1,100. And that's an overestimate. Actually, that's not true. Because in reality, it would be 1,100 minus about 350. It would be about 700 or so. And I'm just rounding numbers up. So in order for you to calculate the exact amount, it would be 1,100 minus 3,500. Take 10% of that. That'll roughly be your CPP owing.
You mean 11,000 minus.
11,000 minus 3,500.
Oh, okay.
Yeah, which would be 7,500. 10% of that would be 750.
Okay, I get it. Thank you.
No, it's a very good point. And generally, when I do my estimates, I'd much rather overestimate than underestimate. So I'd much rather tell the client, listen, Mr. or Mrs. Client, you will likely owe about $1,000 for the client to find out that they owe, let's say, $700, as opposed to for the client to find out they owe $10,000. So I'd rather scare the people and then find out the small number. But yes, that if you miss it, that is a very good point. All right. No other questions? Great. Let's talk about. We won't spend much time on this particular topic, capital cost allowance. This is also, it falls under business expenses. All you need to know is there are certain business expenses that you do not write off in full simultaneously. So if you buy a marker for $1, you write it off as, let's say, supplies, and you deduct it as $1. If you buy a fridge, for instance, or a camera, or a computer, or a car, you don't write it off at the same time, you write it off in chunks. And we can go through this example. What you need to know, the only thing you need to know is you write it off in little bits and pieces. That's it. The details will depend on many different things, but we won't talk about that. We will focus on this. And by the way, I have a slide on, you can find this on my website. Has any of you been on my website, by the way? No? Okay, that's fine. I haven't updated the 2015 figures yet. At some point, probably in a month, as I'm starting to prepare for the 2015 tax year, I'll be updating these. But these are the tax brackets in Canada, at least for the 2014. 2015 will not be much different. If anyone has a problem reading these,
Yeah, thank you.
anyone else wants to use this version? You can download these, and then hopefully in a few weeks I'm going to have the updated. How does this work? So oftentimes people ask me, how much tax am I going to pay on my income? And this is, I find this is a good way for estimates. And once again, this is an overestimate, but I'm quite comfortable with this. So if you know approximately, let's say you're thinking of starting your own business, and actually, yeah, you're female. Let's say you think, okay, I'm going to quit my job, I'm going to start my own business. What's your best guess, let's say, how much you can earn between now and the rest of the year in your own business? Like best estimate.
I haven't thought about it.
Okay.
I mean, like, just throw out a number
Sure.
for the year. Aiming for 45,000 a year.
45,000 a year. Perfect. Keep in mind, you're starting in September. So let's say between now and end of the year, let's say you earn 15 grand. Okay, let's say. Okay, great. So your question would be, okay, how much tax will I need to pay? Because one big difference between being self-employed and employed, if you remember, the remittances that your employer has to do has taxes in it. So every paycheck that you get, the taxes have been held back along with CPP, along with EI. When you're self-employed, the CPP and the tax side, it's up to you. So you have to make sure that you have enough money in your bank account when you file your taxes. And we'll talk about the deadlines coming up. But let's say your income from your other job is, let's say it's 70,000 for the sake of argument. So 70,000 plus 15. So Euphemia is looking at about 85,000, which marginally puts her into 33% tax bracket. What does that mean? So first of all, in Canada, it's very important to realize that we pay taxes marginally. What does that mean? And by the way, we pay both federal and provincial, but it doesn't matter, I collapse them together. So on the first $37,606, you pay 20%. On the next, on the next $6,000, you pay 23%. So up until you hit that number, it's only then you jump. You don't pay 30% on the full amount. Does that make sense? So when you start looking at the average versus marginal tax rate, here, let's say even here, your marginal tax rate is 38%, which is huge. And you think, I'm paying 38%, but your average would be probably less than 20%, or maybe closer to 20%. That doesn't make sense.
Can you repeat the margin and average again?
Sure.
Can I also get a copy, please? I don't think it's
So if, let's say, or you know what, let's take an extreme example, okay? The extreme example, let's say you're making 200,000, okay? On 200,000, marginally, you are in top tax bracket, congratulations. You're paying 46%. But marginally means every new dollar that you're going to earn, you will need to take 46 cents out of that dollar, and you'll need to save it, because that will be your tax. So marginally, you're in a 46% tax bracket. But on average, you're paying much less than 46%. Why? Because on the first 37,000, you're only paying 20%. On the next 6,000, you're only paying another 3%. So when you look at marginally, you're at 46%. On average, you'll probably be closer to, I don't know, let's say 35%. Does that make sense? Mm-hmm. Still, 35% on average is a pretty big tax. However, this is important. Why? Because if Euphemia, for instance, tells me, okay, I earn $70,000 from my employer, and we're not really worried about employer because there's certain taxes have been held back there already. But there's also $50,000 that has not been taxed. So on $85,000, she falls into 33%. Okay. Now with 33%, so that gives an idea. 33%. So that extra $15,000, about a third of it will be given to tax. Right? So right away, if you're thinking, okay, I just earned $15,000, I'm going to take $5,000, put it aside. number one. Number two, there's also going to be, well, at 75,000, she would still need to pay half of the CPP, because one half has already been maximized, and now there is another $2,400 of CPP. So there's going to be about $5,000 of tax. There's going to be about, let's say, about $1,500 of CPP payable on that amount. So roughly, that's how much she would need to have at the end of the year to reconcile her taxes. Does that make sense? And this is very much a ballpark approximation. And oftentimes I get emails from clients who we try to estimate, starting in about January, we start looking at previous tax years so that we know, when it comes to tax time, we know how much money to put into an RRSP, we know how much money they would need to save in their account to make sure the taxes are paid on time. Does that make sense? And the numbers here, they don't have to match. It's not a precise science. All I'm saying is you can use this graphic as an approximation how much tax you need to hold back. And if you have any specific questions, generally a lot of people just send me an email saying, Alexei, I just got a severance of whatever $100,000. I need to know what kind of tax implications I'm going to experience.
So based on that scenario, like let's say I work full time and like it's the same taxes that I usually pay, but and then like a portion of that next 3 months I work self-employed, then let's say I make $1,500 for the next 3 months, then it's like then I pay 20% of tax for that amount, right?
That's right.
And then, okay, just like look at them separately.
You look at them separately because one, the employment component has already been taxed. The self-employment component has never been taxed.
So you don't have to like add it up and then.
So it's ultimately when you at the end of the year you're paying taxes on the full amount, but some of it you've already paid and some of it you haven't paid. And for a lot of people who are self-employed, they don't realize that they're so used to having someone else pay taxes for them, and they don't realize that, listen, when you're self-employed, you're paying your own taxes, plus you're paying your own CPP. And that's why a lot of people get shocked the first year. After that, they realize how the system works, and then they proceed as normal. More questions?
When you have both, like when you're employed and self-employed at the same time,
Yes.
even though your job may take off the taxes,
Yes.
doesn't the money you make as being self-employed increase your tax bracket?
Very good question. So it depends. A perfect example is, let's say you're here. Let's say your income was $90,000. Okay, your income in employment was $90,000, and then you started doing your own thing, and you earned another $6,000. So altogether, you are going to be here. Marginally, you're in the same tax bracket. So
But
then-
what if you put yourself in a new tax bracket?
So
How would you deal with
so
that?
then that's possible, yes. It is quite, it depends on your extra income.
Mhm.
The more income you have, the more taxes you end up paying, yes. Is it worthwhile to reject a job just because it's gonna put you in the next tax bracket? No, it is not.
No, but cause like for me, I had a full-time job up until April, so I would have made some money there. And then with being self-employed, let's say like my other job, they obviously don't take off taxes anymore because I don't work for them. But I still have that income. And then at the end of the year, like I've been self-employed from, let's say, April to December, that very well could put me into a new tax bracket, which means they may not have taken off enough taxes earlier in the year.
That is correct.
So
Yes.
my question would be, how do you prepare yourself for that?
Very good question. Ultimately, I'm gonna take you back to that theory for how taxes work in Canada. At the end of the year, you declare all of your income and you figure out all of the tax. That's it. It doesn't really matter where your income is coming from. Could be employment, self-employment. So you say, I earned $100,000. Those guys held back whatever, $2,000.
Yeah.
And on $100,000, I need to pay $8,000. So I need to make sure I have $6,000 somewhere in order to pay the tax. How do you estimate it? There are calculators online, or you could shoot me an email. This is something I do for people all the time.
Okay.
Because it's when you're prepared for it, it's great. And not only this, but for oftentimes with clients, you know what you anticipated, you prepare for it, but oftentimes what we do is let's say I have one client and I know she's going to pay, let's say, $40,000 in taxes. Very successful young lady. So what we do is we take $40,000, we put it in a bank account that gives very high interest rate up until April. We take it out in April, she pays it. In the meantime, she earned all this interest, and sometimes we make it tax deductible and so on and so forth. So there are other strategies. But yeah, it's can be done, and it's the right strategy for it. Great. Other questions? All right. So let's talk about important dates and deadlines. As I mentioned, the calendar year in Canada is based on January 1st to December 31st. The most important date in our tax calendar is April 30th. Why is it the most important? Because that's when the money is due. What does that mean? Well, April 30th ends up being the deadline for everyone to file their taxes. And there's a caveat which we'll talk about in a minute. But if you are self-employed, your tax owing, which usually includes your CPP depending on the amount, is due on April 30th. But because it's personal filing deadline, for people who are self-employed, or for spouses of people who are self-employed, Canada Revenue Agency gives them an extension. So, technically speaking, you do not have to submit your tax return until June 15th. But regardless, your money has to be in by April 30th. So by this point, some of you are thinking, well, wait a second, if I haven't filed my taxes, like how do I know how much tax I need to pay? Right? Is anyone wondering that? Mm-hmm. And there are several ways. First of all, most people, let's say maybe 70%, 75, 80% people, we actually, even for self-employed people, we file it by April 30th. Most people. It's just sometimes, things get too stressful and then we postpone. But to figure out how much is due, it's not that complicated. And actually, even the example that you provided, just a couple of numbers that can be crunched, and we have an estimate of how much you need to pay. So what people do is they pay that amount, and sometimes we overpay it on purpose. And then when you figure out the full amount, when you file your taxes by, let's say, June 15th, then you get a refund. So in the worst case scenario, you can always get your money back. Because ultimately, Canada Revenue Agency, they don't really, well, they do want your money, but they don't really want your money. And I have a question for you. Thank you. And I have a question for you. How many of you like to get a refund? 1, 2, 3, 4. How many of you do not like to get a refund? Okay.
She's been here before.
I really don't like refunds as well. But I think, I'll tell you, what is a refund? I don't know what a refund is.
Well, I guess it means that they have your money and they're collecting interest on it rather than you.
So ultimately, a refund basically means that formula that I showed you in the beginning. You earned this much income. On this much income, you need to pay this much tax. Well, guess what? You ended up paying more tax than you had to. So when you file your taxes, they realize, wait a second, on this income you need to pay this much tax, you paid more. Guess what? That amount is your refund.
Yeah.
It basically means that you've paid too much tax. And you now get your money back. So truth is, refund is not a good thing. And quite on the contrary, with most of my clients, we try to have a tax owing at the end of the year, specifically, because it's much better, and ultimately means, and for financial advisors, just as a suggestion, because when your client has a tax owing, it basically means they are getting the benefit of using their money up until it's needed. Once it's needed, then yeah, you pay the tax owing. In the meantime, you have these either a month or a week or 6 months that the money could have been growing. So there's an opportunity cost to it. There are a couple of other important things we need to understand. And Mohammed, you brought this up, very important. February 28th, RRSP deadline. So RRSP is a personal retirement pension plan. It stands for Registered Retirement Savings Plan. When you put money into an RRSP, it gives you a deduction. Remember deductions? So deductions are the things that reduce your income. we talked about it. Deductions are very good. So in a situation where a client has a lot of income, let's say, actually, I just had a phone call on Friday. A client of mine has a very large income, a graphic designer, no expenses, or very few expenses. I think there's software and this and that, but income substantially larger. So the client was asking, okay, well, what can I do? And unfortunately in Canada, we don't have a lot of deductions. I mean, if you have kids, there are a couple of childcare deductions, expenses, but they're not a lot. So RRSP ends up being your best option. So in a situation where you have a large tax owing, when you put money into an RRSP, it reduces your income, so you end up owing less tax. How much less tax? Well, that is very easy to figure out. Because as I mentioned, once you figure out your marginal tax bracket, every extra dollar you earn, you need to pay whatever, let's say 38 cents tax on it. Every less dollar, you get 38 cents back. So this is also a very good way to estimate roughly how much of a refund you're going to get. And this kind of refund is a good refund because this is a refund that you planned to receive as opposed to receiving willy-nilly. Yes?
So for the RRSP, do I also put 4.95%, or is it up to me? Like, is there an upper ceiling?
Good question.
18% of your income.
Yes and no. So RRSP is a formula, and the formula is made up of 4 different components, 4 or 5. It is made up of the carry forward amount that you have in the past, because every year that you work in Canada, you create room, RRSP contribution room. And generally, Canada Revenue Agency, they track it. If you guys have seen your notice of assessment, on the bottom of your notice of assessment, it has your RRSP contribution room. So it's your contribution room plus 18% of your previous year's earned income. We won't go into the definition of earned income. Minus pension adjustment. Pension adjustment is your plus your employer's contribution into your pension plan, plus your pension adjustment reversal, which we won't talk about, minus your PSPA, which is past service pension adjustment. So it's a complicated formula. It is actually, once you look at it, it's not that complicated because usually the last 2 components are not there. But, and a good estimate is 18%, which is, it's true, it's 18% of your previous year's earned income, which is also, there are a couple of interesting definitions within the word earned. But whenever you do not contribute to your RRSP, it gets added, it gets carried forward into the future. So oftentimes if you've never contributed, and if you've worked in Canada for a long time, you end up creating a lot of room. And sometimes we actually use this to, so this is a perfect example. For this particular client, who never contributed to an RRSP, now has a whack of money that she's making. And what we're going to do, we're going to take a chunk of it, not all of it, but a chunk of it, we're going to put it into an RRSP. But there are certain strategies that you use, it's just one of them. RRSP is a useful tool, but it's just one. Good question. Any other questions? Yes?
How long, if you want to take money out of your RRSP, how long do you have to keep it in there? Or does it matter?
Very good question. So on RRSP, and this is an area that is also quite confusing, because RRSP, it's a tool. It's a very useful tool, but it has a lot of restrictions and a lot of limitations. So the way RRSP works is when you put the money in, you get a deduction. A deduction, you get more refund, and the money ends up being invested in an RRSP account, which is tax sheltered, which means the growth on it does not get taxed. But there are only 4 instances when you can take the money out. One of these instances, so once the money is in an RRSP, taking it out is actually very difficult. And from a tax purpose, from a tax perspective, it's rarely advantageous. So once the money in an RRSP, you can take it out, you can pull the money out, just withdraw it, but you'll have so many tax that kick in, and it's not worth it. There are 2 instances when it is worthwhile. One of them is the home buyer's plan. So when you take money from an RRSP in order to buy your first property in Canada. Number 2, when you take money from an RRSP to participate in a lifelong learning plan, which is if you decide to go back to school to do your graduate degree, you can take money out of an RRSP. Both of these have a rule that you have to recontribute the money over the following, I think 15 years in one case and 10 years in the other case. So there are 3 times when you can take the money out of an RSP, and there are a couple of other instances, but generally once the money is in an RSP, it's pretty much locked. You don't have access to it. Well, you do. Technically speaking, you can withdraw it, but the tax implications of withdrawing are so painful, and
You lose half your money.
you lose. You don't end up losing half your money, but you lose a big chunk.
Mhm.
Yeah, and it also becomes income for the following year for you, so it's just nasty. Having said that, the reason, so RSP, it's a tool. What's the purpose of the tool? Pensions. We talked about Canada Pension Plan. So you start withdrawing money in an RSP when you hit, let's say, from the age of 60, or let's say, you have to start withdrawing by the age of 71. And how much, and it's a whole other discussion of what happens at the age of 71, but by that point you have to start withdrawing either in small pieces or in other options. Where it becomes useful is, it's one of the, when you start getting into retirement planning, because the goal of retirement planning is to create a system where when you retire, you have money coming to you from CPP, Canada Pension Plan, from your personal pension plan, your RSP, from your, maybe from your businesses, from your rental properties. That's the goal. So it's just one of the tools. It's a useful tool, but it's not always useful, and it's not useful for everyone, by the way. So that's why when people say put money into an RSP, sometimes it's not a good strategy. Very good question. Other questions?
No, I just want to make a comment on the RSP. Like right now with me meeting with clients, they're always asking about the RSPs, and the question that I ask them is that would they like a lower standard of living in retirement years? Because when you're in your retirement years, a lot of times, from the statistic that I read, 7 out of 10 Canadians will be in a higher tax bracket. So when they start withdrawing money from RSPs, they'll be in a higher tax bracket. So then the money gets taxed at a higher tax rate. And the analogy we always use is, in our business is, would you rather pay tax on the seed or on the harvest? So once you accumulate the money in the RSPs, it's like a bigger pie that the government can start taxing you on.
Sure. It's a very good point. And by the way, the graphic that I showed you in the beginning, how taxes work, it applies in retirement the same way, because you pay taxes on all of your income. And it's also a very good point because I have one client, and he happens to be involved in real estate. And what he does is he buys out properties. So let's say now he has about 10. He'll be, I don't know, when he retires, he might, let's say he has 20 properties. And let's say every property pays him $1,000 a month when he retires. So let's say he gets $20,000 a month. So for him, with such a large income, let's say he makes $240,000 a year. For him, having an RSP would be detrimental because he's going to be in the top tax bracket, which basically means that every dollar he's going to get from an RSP, he's going to be paying taxes at the 46% level. By that point, it might be even higher than 46%. So John's point, and it's very true, with the assumption that your income is going to be lower, which happens to be for most people, just because most people get their income from working, and once you stop working, your income is not the same. So for them, an RSP works. For my clients, we're not touching RSPs for that reason. We have other investments. Yeah, thank you.
So to John's comment, does this mean that we don't want to put a lot of money in our RSPs?
So an RSP, it's a tool, and it works for some people, but you have to, in a way, you have to customize it. You look at the first person's overall picture. For some people, if you're going to tell me that when you retire, let's say, I don't know, at the age of 65, whatever your number, at the age of 60, you will have a lot of income from, let's say, outside of the world, which will put you in a top tax bracket, I would say don't get RSPs. It's not going to. Usually, now you will get you'll get some benefit because you get a tax break at this moment, but it won't be that much of a benefit for you. Yeah, but it's very valid. Any other questions? And we're jumping a little bit further outside of the scope, but this is interesting still. We're not going to spend much time on GST filing. I'll tell you just the bottom line with GST filing. Whenever your income, your net income, and by the way, generally when I say income now, I'm talking about net income as opposed to gross income. Whenever your net income starts hitting about when it hits $30,000, If it hits $30,000 in 4 consecutive quarters, then you have to register for GST. Up until that point, it's voluntary. With some industries, they force you to register for GSTs, but technically speaking, you're not required until you have either 4 consecutive quarters that add up to 30,000 or 30,000 in a year. GST complicates things a little bit. I mean, not really, but it ends up being the two systems end up going in parallel. So there's certain GST that you collect, certain GST that you send to Canada Revenue Agency, and so on and so forth. But unless any of you in this room are planning to start paying GST, I know in the financial services it's rare. I think most financial services there is no GST just by definition. Let's say with my business, on the tax side, I know this is something that I'll be doing relatively soon. But I have different sides to I have the tax side, the insurance side, the investment side, but on the investment insurance side there's no GST. This is something that I was going to leave, and the next few minutes, you may find these helpful. CRA does have a lot of guides. You can also call the help desk. There's the CRA general line with a caveat, and the caveat is if the question is truly complicated, what I sometimes do is I call the general line several times. And it is quite often, unfortunately, that you get different answers on the same question from different people depending on who is answering the phone at the time. It is unfortunate, but this has been my personal experience. Be aware of it. But the guides that are written are very useful. And what we are going to do is we are going to talk about useful practices. I find this quite charming. So a few things. When you're starting your own business, the next couple of minutes, actually I think we'll be wrapped up in just a few minutes. What I wanted to mention is a few things. Number one, anything that has to do with your business, you need to save all of the receipts. Now, Moses, you had a question about scanned receipt versus physical receipt. Take a picture of the receipt. Ultimately, when you get audited and CRA asks you for a receipt, it does not have to be the physical receipt. A photocopy is fine, but a receipt needs to have certain information on it. It has to have name of the store, date, amount, indication of what it is that you paid. So a picture is perfectly fine if you print it out. It's perfectly fine. A lot of receipts have a tendency to fade with time. And but where things get complicated is a lot of people think that they can use their credit card statements or bank statements as receipts. Generally, the answer is no. The way CRA usually looks at it, no receipt, no deduction.
I have a question.
And how does the process work? When you submit your taxes, you say, my income was whatever the amount it was, my business expenses were whatever they were, and then you go category by category, and they can say, okay, you mentioned that you spent $1,000 in advertising, we'd like to see the receipts. So you need to send them the receipts. So it doesn't have to be, but if it is printed out and it looks like a receipt, it's fine. Number one, so save the receipts. And we talked about the car log. It is important. Next thing, if you have your own business, one big suggestion, not everyone does it, but this is something I highly recommend, and you'll see why in a minute. Separate your personal life and your business life. What does that mean? It means get a separate bank account for your business. It doesn't have to be a business bank account. It can be with the same bank. When I was self-employed for a few years before I incorporated, I had several accounts in my account. I had several checking accounts, and I used one checking account exclusively for the business. That's it. Also, get a credit card just for the business. Doesn't have to be, don't go out of your way, but most of us have several business cards, several credit cards. So take one and allocate it specifically to the business. Why? It makes life easy, number one. Number two, it makes life easier in case you get audited, which is a possibility. Number three, it makes life a lot easier if you decide to incorporate. Now, we haven't talked about a corporation. We'll spend a couple minutes, actually we'll spend a minute on it now. Because a corporation is a separate tax entity from you. So when you are self-employed, you are your business and your business is you. And you can have 20 different businesses, it doesn't matter. You can have 20 different businesses. When you declare your taxes, you end up showing the income expenses for every business, and then it gets summed up and you say, my business, my income was this, my taxes were these, or my expenses were these.
It's two business, two share account. Is it?
If you have two completely, so it's a good question.
Some people
Maybe.
have
Why not?
to do free business.
Why not? It might be easier.
Yeah.
It may sound more complicated, but I think in the long run, having everything separated. Now, if the businesses overlap, if you're a graphic designer and you're an artist, and I don't know, maybe you do wall painting, for instance. So there's quite a bit of an overlap. I mean, here you might want to keep the same account, but if it's completely, you have your music business and your painting business, I suggest keep those separate. Corporations. So, when you are self-employed, you are the business, business is you. When you incorporate, your corporation is a completely separate entity. The two biggest reasons why people do it, number one, liability. What does that mean? If you are self-employed and someone sues you for whatever reason, and let's say you lose, and let's say you owe, the judge says you owe them $1 million, so that $1 million can come out of your personal assets. If you are incorporated, they usually sue the corporation, and the corporation now owes $1 million. Now, oftentimes you get, it's both and so on and so forth, but usually having a corporation protects your personal assets, number one. Number two, there are some tax benefits on the corporate side, but generally we don't see these until your income starts hitting pretty large numbers. So once your income is more than 150, 170, once you start getting closer to 200,000, then you start seeing a difference on the tax side, because in a corporation, you do not have to take all of the money out. So that goes back to Mohammed's question, because when you're self-employed, all of your income is all of your income. It's not that you pay yourself, your company pays, no. All of your income is your income regardless of how many companies you have. When you have a corporation, the money goes to the corporation has certain business expenses, whatever is left, the corporation will be paying taxes on it. Corporate tax rate in BC, 14%, 13.5%. Personal tax rate in BC, highest level, 46%, so it's a substantial difference. But the corporation, you don't have to take the money out, and there's a lot of planning and strategizing and investing you can do, and insurance you can use within the corporation. It's a whole different story. So, but these are the two biggest reasons. And generally, having a habit of keeping your business separate from your personal life makes a big difference. And anything that I have not covered yet, because on the practical side,
I just had a question about receipts.
yes.
If we go to business functions that, let's say, like we're all, in my business, we're all independent
Yeah.
Consultants, but the people who are training us will go and organize events, and we have to pay our share when we go there. They tell us to write our own receipts. Are we, we're allowed to do that as long as it has the information on there?
Yeah, and that's the thing. Actually, generally, yes, you can.
Okay.
And this question sometimes comes up, is if you buy something for the business, but you don't have a receipt. Let's say you buy something on Craigslist.
Mm-hmm.
So you meet a guy or a girl and you buy whatever it is from them. You don't have a receipt, so what you can do is you can write a receipt by hand.
Okay.
You can, if they want to sign it, get them to sign it. If they want to sign, make a note. Listen, I bought it on Craigslist. Here is a copy of the ad, whatever it is.
Yeah.
No, because sometimes an organization will issue you a receipt of sorts. Sometimes they give you a summary. You say, listen, during the year you attended 20 meetings. You paid us $200.
Mm-hmm.
Sometimes they don't, but it's an expense rate.
Yeah.
Some people, if it's a regular thing, that sometimes you could potentially use it as a credit statement. The reason why credit card statements, or the reason why they're not good from a CRA's perspective, is because they don't indicate enough information. Let's say, I don't know, let's say it says Petro-Canada, you spent $50.
Could have been on junk.
Could have been gas, could have been food, could have been logs, could have been ice, I don't know. But if it's something, if you say I go to a networking event, for instance, and I charge my with meetups, for instance, yeah, you get meetup. So in that case, if you couldn't have spent this money on anything other than admission to an event, then that's fine. But at the same time, writing a receipt for yourself, that's not an issue.
If I could add one thing, in your industry, it's really good to use Eventbrite and other kind of programs, because then that way it actually creates a receipt for everyone. So you can always, yeah, so then that way if it's a convention, or if it's just, you know, a monthly meeting that's big and people are paying money, then if you do it on Eventbrite, first you have a list of everybody that paid, so it's easier for the organizers to break down what they have to disclose, and then for you, it creates a receipt for you. So you can always suggest that.
Cool. I didn't know. Okay. Yes.
Yeah, about incorporating, is it always, like, regardless of how much you make, like, from zero to, like, a lot, like, is it always more beneficial to incorporate rather than be?
No. And for a lot of people, they actually make a mistake of incorporating. Not only because it makes things a lot more complicated, corporation is a very complicated thing. The corporation process, I mean, you can do it by yourself, it costs $400 if you do it online, but generally I suggest for most people to go to a lawyer, because there are many ways to go wrong in the process of incorporating. But for the most part,
Because based on what you told us at the last bit of your lecture, like,
yeah.
I was like, oh, incorporating, it sounds like it's, you know, like you're not liable, you know, protects all your personal assets, everything, it sounds like it's more beneficial,
So it's a lot more administratively complicated. It's a lot more expensive. The corporation, most lawyers will charge you, let's say, $1,500 to incorporate, but every year when you do your taxes will cost you about $1,000. Let's say, as opposed to 300, 400 500 when you do it somewhere else. And unless there is a reason, and if every industry is different. Maybe in your industry people get sued a lot. If that's the case, maybe. But I'd say until your income starts to get really high, it's definitely not a black and white thing. Yes, you should incorporate. Everyone should. No way. No. It depends on a number of things. Mohammed, you had a question?
If I have two separate accounts, my question is about the salaries. I have two separate accounts.
Sure.
My business account and my personal account.
Good.
And I pay salaries from the business account to the people who are working with me.
Yes.
But I'm also one of the people. So I transfer money I pay myself from the business account too.
So my question is, so you're not incorporated, right? You're self-employed for that.
So my question was about actually the two situations. So if I am incorporated versus not incorporated, can I say that the salary I paid myself is also, like, can I deduct it in the two situations, whether it's an incorporation or not?
Okay, so once you create a corporation is a completely separate story from you. So every time you want to withdraw money from a corporation, there are several ways of doing it, but generally the corporation would need to write you a check. And now your corporation, you think it has nothing to do with it. The fact that you're the shareholder, the only shareholder, that's irrelevant. It's a completely separate story. That's, I don't know if that answers your question, but that's generally the best way of looking at it.
Yes, because my goal is to pay less taxes in the two situations, whether I have an incorporation or not.
So it's not just about taxes, because keep in mind, yes, corporations pay a lot less tax on the net income, but corporations are much more complicated, number one. Number two, let's say, so corporations, when a corporation gives you money, you still have to pay personal taxes on it. And it used to be, because corporation has different ways of giving money to you, let's say salary versus dividends, and there are different tax implications. Used to be one was much more advantageous, now they're becoming very similar, there is not really an advantage. So it's not a black and white question. I'd say, you know what, give me more information, maybe there was gonna be a better one, an obvious better one, but generally it's a multifactorial type of an answer, as opposed to just, so many, you need to look at many different things in order to figure out the best thing for you.
So what I'm hearing is, in general, because we had here in the list, we had the salaries, so I can put the salaries as a deduction if it's my own business, not an incorporation, but not my own salary, if I'm paying myself, right?
So if you're self-employed, your own salary, it doesn't really make sense, because you're basically taking money out of this pocket, putting it into this pocket, and vice versa. But the salary you pay to someone else is a business expense on the self-employment side, but also on the corporate side. So if your corporation pays someone, gives someone money, that's a business expense. And it will be salary for them in both cases.
Thanks.
More questions? Well, great. If there are no more questions, so just a summary. We started the meeting talking about how taxes work in Canada, and I hope between the income, the deductions, and the tax credits, you kind of get an idea. Keep in mind, the goal for this event was not so that you come out and you're perfectly qualified to do taxes for other people, but it's slow and little exposure to different tax topics generally will get people to understand the matter more. We talked about differences between employment and self-employment, income expenses, deductions. We talked about dates and deadlines. And we had a couple of things that we discussed on the practical side of running business. Anything else in terms of questions? If there are any questions, I'll be around for a few more minutes. Feel free to stick around. Number one. Number two, a couple of other events that we have as a part of the meetup group. So on every second Thursday, I think it's going to be this Thursday, we have a financial mastermind webinar. And basically people log in and everyone comes up with a list of financial goals that they are working on. And every couple of weeks we check in and we see how people are doing on their financial goals. I only started this about 3 meetings ago, so right now I have maybe 1 or 2 people show up. But hey, and that's Thursday at noon, it's online. I have October 6th, Tuesday, Investing for Absolute Beginners, 10 strategies for selling your property and making more money. There's going to be someone talking about selling real estate, not my area of expertise. Now, Thursday, October 22nd is going to be an interesting meetup, a very different one. I'm bringing in not a psychologist, but a financial counselor. So someone who helps people overcome their beliefs. Because I find a lot of my clients, especially some of my wealthier clients, they had to overcome certain beliefs that they had about money in order for them to become successful. So if it's of interest, check it out. It should be I'm quite excited about it. Other than that, feel free to connect with me on LinkedIn, and you have my contact information. So last thing before you go. Number one, there is refreshments. I hope they're still there. If there are no birds or squirrels, feel free to stick around to eat. Number two, in your packages you'll find a feedback form. I'm going to ask you to take a minute or 2 to fill it out. Number 3, I think, if for whatever reason, if you have not yet paid, please do so. I think most of you have. Perfect. And I'm also going to ask you if you don't mind writing a couple of words on the meetup event as a feedback, either on this page or on the meetup event itself. And other than that, it was a pleasure meeting everyone. Feel free to stick around to chat or exchange business cards if you heard someone doing the type of work that you're interested in doing. Yes?
And so, let's say as a freelancer or self-employed, as long as I keep all my receipts and all my invoices, and if I don't want to deal with any of this, do I just pay someone?
You can pay someone like me,
Oh.
or you can walk into.
How much is it?
It's a very good question. Every company charges a different amount. Generally, for self-employed tax returns, my price would range 270 to 350. Usually falls within that range, depending on how complicated it gets. And it is something you get to write off the following year as a business expense.
Oh, I think.
But for a lot of, and this is, as I mentioned, my business model is because I do taxes, I do investments, and I do insurance.
Mm-hmm.
And a lot of my clients happen to be self-employed. Because a lot of people I work with, they love what they do, but when it comes to this stuff, they're not so, they'd rather spend their time, seeing clients, selling things, designing things, whatever it is that they do.
So as long as we keep all the invoices, receipts.
Yes. And other than that, thank you for coming, and I hope to those of you who have been to a meetup for the first time, great, welcome, congratulations, you survived. And thank you.
Thank you.
And yes, I will be here in the next few minutes. Feel free.